Before we start and look at 2007, we got to put it in context. So let's take a look back at 2005 and 2006, which were both very strong years. We had $1.2 billion in total transactions volume in 2005 and $1.4 billion in 2006. So what happened in 2007? We more than doubled volume to $3 billion. Now, there were two major retail portfolio transactions that helped propel us to this level. The first is Westfield's sale of 4 St. Louis regional malls for $1 billion. The second is Desco's sale of 25 Schnucks grocery-anchored centers for $350 million. But even if you take those two large transactions out of the mix, we go to $1.7 billion, which is almost a 20% increase over the record volume we achieved in 2006. So let's take a look at the major transactions that occurred in 2007, and we'll start with office transactions. You had the sale of Creve Coeur Center and Westport Plaza as the largest office transactions in 2007. Both of these complexes have sold for the second time in the last few years as their owners increased occupancy and net income and sold them for a profit. Now let's take a look at industrial. Duke sold a portion of its industrial portfolio here in St. Louis, and Panattoni sold Lakeview Commerce Center 1. Interestingly, both of these transactions were acquired by West Coast-based investors who were completing 1031 tax-deferred exchanges. And last but not least, let's take a look at the multifamily market. The two largest transactions, Oxford Hills and Pheasant Point, were both acquired by the same investor, Raleigh, North Carolina-based Stephen D. Bell & Company, as it expanded its geographic reach into the St. Louis market. So, 2007, it was a year of big deals and huge volume. But it was definitely a tale of two markets. You had the first 8 months, which were smooth sailing. And you had the last 4 months, it was very choppy. And there was a whole lot of uncertainty out in the marketplace. Well, what happened? The credit markets exploded, resulting in a credit crunch. The credit crunch resulted from a huge shock to the system caused by the meltdown in the subprime mortgage markets. Now, we've all read and heard about the meltdown in the subprime mortgage markets, including the huge losses incurred by investors and lenders, lax underwriting, and questionable credit ratings from the credit rating agencies. But the real question is, why are problems in the subprime residential market having an impact in the commercial real estate markets? And for the answer, we're going to turn to our resident finance professor, Paul Hilton.
Thanks, Mike. Well, there's a couple things we want to point out. First of all, if you look at the market fundamentals on the commercial side, they're really quite strong. You heard from our presenters today, things are going very well just about in every segment of the market. So the problem on the commercial side has nothing to do with the fundamentals. It's a debt problem we have. And it's a debt problem that's isolated to a certain segment of the market that we call commercial mortgage-backed securities. The acronym being CMBS, also known as conduit loans. Now, you might be asking yourself, how can one segment of the debt market create such turmoil on the overall market? Well, take a look at this slide. You probably didn't realize, but CMBS loans account for 25% of the loans outstanding. When you take 25% out of anything, there's going to be changes. Now, I still haven't answered what the tie is between the commercial and the residential. Before I do that, let's take a look at CMBS loans and see how those work. When a lender does a loan, what they typically do is they pool them together and they sell them to investors. Now, historically, they have taken this pool and sold it to one investor. That is not what happens today. Today, what they do is they take that same pool of loan and they divide it into what are known as tranches, basically groupings, based on the level of risk. The rating agencies come in, they rate the debt from AAA down to junk status. Now, you have to remember, we're coming out of a period of very low yields, and investors were chasing yields. So there's no better way to get a good yield than to buy junk bonds. Now remember, we haven't had a lot of problems on the commercial side. In fact, if you look at the default rates on the commercial loans, they've been very low. But here's the problem. The buyer of the junk bonds on the commercial side were also the buyers of the junk bonds on the residential side. And when the trouble hit on the residential side, they threw their hands up and said, stop. We're not buying any more junk bonds until we realize the extent of our loan problems. And that's when the market shut down. Take a look at this graph. This is a 10-year analysis. These are spreads over treasuries for the various CMBS loans. It ranged from 50 to 200 basis points for almost 10 years. Third quarter of last year, boom, look what happened. The spreads increased to over 600 basis points. That's when the market shut down. Mike's now going to talk to you about how that has affected the value of real estate.
Well, there's still a lot of volatility in today's debt market. As Paul discussed, the CMBS lenders are basically on the sidelines. So that's 25% of the debt capital that's out of the market. So there's less debt capital available today. And the law of supply and demand applies. Where there's less supply, prices are going to go up. So borrowers today are paying more for debt than they did before the credit crunch. And finally, lenders have a bigger aversion to risk today than they did in the past. And that has resulted in lower leverage levels. Before the crunch, it was fairly common to get loan-to-value ratios in the 75 to 85% range. Today, it's much more common to be in the 65 to 75% range. So what's been the impact on pricing? Well, for core product, cap rates are up slightly. And since cap rates and prices have an inverse relationship, that means prices are down slightly. But it's a whole different story for Class B assets and value-added assets. Cap rates for those assets have risen by between 50 and 150 basis points, and prices have fallen dramatically. Now, there are two issues that these assets face today. One is the risk aversion that we talked about earlier. There's all of a sudden a new appreciation for risk, and people need higher premiums to take on that risk. And the second issue is the fact that CMBS lenders are on the sidelines. With them on the sidelines, they were the most aggressive and prolific lenders for both of these types of assets. So, where are we headed? Paul's going to give you our predictions for 2008.
Well, given the turmoil in the market, it's tough to make predictions going forward. So Mike and I felt like we needed a little help. So we went to the closet, pulled out the old crystal ball. And here's what we came up with. Our first prediction, we think transaction volume will be down. Without the CMBS lenders, 25% of the market not lending money, obviously volume will be down for that reason. The second reason we think volume will be down, we've come through an era of cap rate compression. That era has now ended. In order to increase the value of real estate, you have to increase the net operating income. Unfortunately for investment brokers like Mike and I, that takes a little longer. Our second prediction, we think the buyer profile will change. Cash will be king. Investors who can come to the table, such as institutions with a large amount of cash, will be buying a lot more real estate than the leverage buyers of the past. Our third prediction, and something people might be overlooking, the lenders are under a lot of scrutiny these days. The banks are under scrutiny, and even all the other segments of the market are under scrutiny. So they're being a lot more conservative. For a developer to build a speculative building, we believe the lenders are going to require additional equity in the transaction. If a developer has to put additional equity in the transaction, that means additional risk for them. If you do the math, if a developer wants a 50 basis points increase in their return for an office building, that increases the rental rate by $2 a foot. Our last prediction, and some good news. We think there was an overreaction in the marketplace. We think once these large financial institutions work through their bad loans on the residential side, that they'll be back in the market, likely by the end of the year. We don't think that they'll be at the same aggressive levels they were in the past, but they'll be definitely back in the market, creating additional opportunities for loans.